This video will cover depository institutions, banks, and balance sheets. I'll introduce commercial bank balance sheet first as the way to introduce these concepts. It's important you get an understanding of a bank's balance sheet because you're going to see it later on in the course. We'll compare and contrast various types of commercial banks. We'll describe select bank services. And then we'll talk about capital and profitability measures, and we'll look at the concept of leverage. We'll discuss off-balance sheet transactions and agreements, which are very important. They're a little more nebulous and abstract than, say, a bank investing in a loan, which is a balance sheet transaction and shows up on the balance sheet. But I think off-balance sheet transactions are a little harder to grasp. So we'll spend some time and look at specific examples. Then we'll compare and contrast various savings institutions. That's easier said than done in today's world. These savings institutions may have been very different years ago, and that's the motivation for why they exist in today's world. But they're very similar today, and in fact, they're very similar to commercial banks. We'll also discuss interest rate risk and duration analysis, which is a very important concept to see why banks failed in the past frequently. Now let's focus in on what a commercial bank balance sheet looks like. So let's start out a bank looking at its balance sheet. We're going to start it out from scratch. So a bank has assets, it has liabilities, it has equity, which often in bank terms is called capital. I'll often use the word capital and equity interchangeably, but often the word capital is used, although it's just like equity that you studied in financial accounting for a manufacturing firm, for example. So when a bank starts up, let's look at how would you start it up? How does a bank start? Well, it's kind of like a mutual fund and other financial institutions. It starts with seed money. So somebody deposits, the owner deposits, say, $100 in the bank, and that becomes common stock. So the owner gets issued common stock after depositing $100 in the bank. Mutual fund starts out, I think the seed money is required to be about $100,000. So this would be $100,000 in a mutual fund, and then the cash would be $100,000. Okay, so it starts out, the balance sheet balances, right? That's why it's called a balance sheet, and that's pretty straightforward. Now, before we go further, let's look at a capital ratio, a basic capital ratio. It's a ratio. There's lots of other capital ratios that we're going to look at later on, like risk-adjusted capital ratios and so on. And so we first just want to get a handle on what this is about. So a capital ratio, the very basic one that we can do, old-fashioned one because it's very simple to calculate, it takes the equity, the capital, divided by the total assets. And in this case, it's 100 over 100, and it's just 1. No bank has 100% capital. This number is usually about 10% or less for a total capital ratio, like we're looking at a basic capital ratio here. But nevertheless, we need to interpret what this ratio means. It says, look, in this case, the bank would have to, its assets would have to drop off 100% before the bank had zero capital, which means it's basically insolvent. Okay, but we can't go very far in this example because no bank has just cash and common stock. So let's look at a bank starting up, and it starts to collect demand deposits. Individuals start depositing money in checking accounts. So that's what demand deposits are. You can pull your money out on demand. You can write as many checks as you want, and the checks can be for any dollar amount. And it's first come, first serve. So then what that means is somebody deposited, or some people deposited $900. So that means now the cash balance here is going to be $1,000. And so total assets are 1,000 and liabilities and equity are 1,000. Okay, now we got to zero in on this guy because this is an important concept that's here. So what does cash in a bank represent? Well, it represents a number of things. It represents cash that's in a vault, cash that's in ATMs. It could be cash that's due from another bank because of check processing delays. So when you deposit money in the bank will credit your account before they actually get the cash from the other bank. And so what they'll do is they'll increase cash, and it'll just be due from that other financial institution. And so it may not actually be there, but they'll call it cash because they expect to receive it. Then there's also cash that's in the form of what's called reserves at the Federal Reserve. Really important term. So banks not only actually hold cash in their vault and ATMs and expect some money from other financial institutions, they actually hold some deposits at the Federal Reserve, which we have a lot to say about later on in this course. And it also could be, by the way, that this could be a small bank. Small banks often do correspondent banking with a larger bank. So a larger bank will offer correspondent banking services. And what that means is, look, a small bank may not be able to handle international transactions or big transactions, and it will rely on a larger bank to help them process and settle those accounts. What's important here at this point is, in much of this course, we're going to have a cash balance, but it's not going to be called a cash balance. It's going to be called reserves. And basically what that means is, look, it's on reserve in case people want to pull their money out in terms of deposits. Normally there's a huge number here, and the reserves are small, but usually under normal or economic situations, that's the case. But this is just an example here. So my point is, cash is often just simply referred to as reserves. Now, before we go further, let me get a green pen out here and tell you that banks have reserve requirements. So you have total reserves, and they're equal to required reserves plus excess reserves. And so for a good way to look at reserve requirements, a good way to bench it is to say, look, 10% of all transactional deposits, of which demand deposits are the biggest component, must be held on a reserve in case people want to pull their money out of the bank. The reserve requirement would be 10%. And what do they do with the rest of the 90%? Well, the rest of the 90% goes into loans. So what happens is, this will be $90 because it needs to be 10% of the 900, right? So that matches up. This will have to be 910 to get this to be, keep this to be $1,000 on each side. So there we have loans of 910. Well, obviously a bank needs to make money, and that's where it makes its money, through loans. Yeah, so now in this case where I have $90 in reserves, our total reserves are 90. It happens to be all required reserves, and we have zero excess reserves because we lent everything out that we could, except for this $90. So therefore we meet our reserve requirements. Let's calculate our capital ratio at this point. Well, our capital ratio is still 100, our equity is still 100, our total assets are 1,000. And so now we're looking at a more realistic capital ratio, basic capital ratio, which is 10%. Like I said, we'll look at various capital ratios, and this is ballpark reasonable for what we want to do here. Now, let's look at calculating a reserve requirement. So this is what I want to do here to make sure it's clear, because students often get confused. They say, well, okay, there's capital ratio requirements that the Federal Reserve and other regulatory institutions impose on a bank. So there's capital requirements, and then there's reserve requirements, and they get tangled up between the two. Well, here's the way to think of it is, look, reserves and the demand deposits and other deposits here, they're up top, the upper part of this balance sheet. And so if you have demand deposits and you have other deposits, there needs to be reserves to back it up, so that if people line up outside your bank, you have the cash to pay them off. It's a liquidity thing. This is liquidity, having these reserves here. Now, capital ratios have to do with solvency. And so I like to think of it as this. It's how much capital stock do you have to total assets? In this case, if this bank was to go bankrupt, this bank would have to lose 10% of its total assets. It would have to drop to $900 before this gets eaten away. That's how much you would experience in losses, and that's what that total capital ratio here is telling you. You have to lose 10% here in order to wipe out your capital and become insolvent. Just to be clear, reserve ratio is calculated as this. It's reserves divided by deposits. And in this case, it's 90 over 900, and it's 10%. Just happened chance that it's 10%, that they're both equal here. So it's not unreasonable. A capital ratio in the ballpark of 10% or even a little less is pretty normal. Now, we'll look at other ratios that are a little bit higher than this for capital. It depends how it's calculated. We'll talk about that later. But the point is now we have capital ratios, we have reserve ratios. And the reserve ratio at 10% happens to be a really good number for a reserve requirement. So for a very, very long time, decades, we had a reserve requirement, a ballpark of about 10%, a really good number. Historically, it's been all over the map, but reserve requirements have been around, and reserves in general have been around reserves themselves have been around for centuries. Reserve requirements go back even into the 1800s. Now, by the way, since March of 2020, a required reserve requirement has actually dropped to zero because we are in an ample reserve regime. Ample reserve regime, according to the Federal Reserve. And so they dropped this reserve requirement to be zero, which means technically a bank could lend out all its cash and not only lend it out, but buy securities, and it doesn't have to hold anything on reserve, which is kind of scary, you would think. It's a little scary to me, given that, it seems that these reserve requirements make sense. You need to hold some cash. But it turns out that Fed will be prepared to give a bank, an individual bank, the cash it needs if there's a run on its deposits. So an important reason for this reserve requirement is, given the situation with the coronavirus, the Fed wants banks to lend out as much as possible to spur economic activity instead of shutting economic activity down. So it's pretty easy for a bank to get nervous about whether its customers can pay back loans when you drop into a recession. They're scratching their head. Is this customer really going to be able to keep their head above the water? And when you're in a bad recession, the answer to that may be they may not. So banks are being encouraged by the Federal Reserve to lend as much as they can to keep the economy afloat. And that's part of the Federal Reserve's requirement mandate. We'll talk about what that mandate means later on. Now let's look at a bank's income statement carefully. Most textbooks don't do it justice, so we'll spend a few minutes looking at it. So here's an income statement. And it's going to have interest income. Okay, obviously it's lending and it's buying securities, although I haven't put them in there. So that's interest income. It's going to have interest expense. Now, demand deposits usually have either the interest rate that's zero or really close to it. And you might ask, well, what's the incentive of putting your money into a bank? Well, you get a lot of services because you can write those checks, like I said earlier, for almost any amount and as many as you want, and that money's on demand. That's liquidity. Plus you get access to ATMs and so on. So there's usually no interest rate associated with that. There's interest expense, though, associated with time deposits and other deposits and other liabilities, which I have not modeled here. And a little later on in this video, I'll show you what the average actual bank looks like on a consolidated basis across the entire country from the FDIC, the Federal Deposit Insurance Company, which will look kind of cool. But we're starting off small here. We're not going to get into that detail. Now, let's look here at the difference between these two. The difference between these two is going to be called net interest margin. It's an important term. It's sometimes called spread. And this could be a big part of a bank's income statement, a very big part, which is why it's usually up at the top of the income statement. Now, keep in mind, though, we're in weird times. Interest rates are near zero. They're in general for short-term treasuries, for example, they're near zero, which is sometimes like the close to the base rate we'll talk about later, base rate pricing of loans. But these numbers are fairly low. Even for loans, they're fairly low. But remember, there's going to be risk premiums associated with this, which I'll show you a little later. So this is historically low. It's not zero, which means your net interest margin will tend to be low. And so what the banks do to offset that, because, wow, if you have a really low interest rate environment, how can a bank make money and actually stay in business, which is a good question. Well, they charge a lot of fees and other charges, for various services that they provide. They provide a lot of services. So that's positive on the positive side. And then there's administrative expenses, and that's on the negative side. And then there's going to be taxes, for example, and that's on the negative side. You've got to have net income. Now, I left a little space here for the most important component, the most volatile component of an income statement of a bank, and that's the allowance for loan losses. So I worked for a bank for a long time. We used to have to estimate this because this was the most volatile number in the entire income statement. I'd come into work, and this number would shoot up by 50 million because we had a loan go bad overnight, and I was totally surprised. Management was caught off guard, but suddenly we find out one of our customers went bankrupt. And so this is allowance for loan loss. It's kind of like allowance for bad debt. So when you're a retailer or a manufacturer and you sell your good to another company and you haven't gotten the money yet, it's accounts receivable. Well, this is kind of like an accounts receivable, these loans. And so manufacturing and retailers don't get paid all their accounts receivable because their customers just don't pay them. Well, the same thing happens with a bank, but it's usually at big chunks. It can be big chunks. There's often lots of little bad loans, but this is unstabling. And so you got to look at this very carefully. We would project out as best we can. We'd look at and scour our entire loan portfolio to see what loans possibly would go bad. We'd consider where we are in the business cycle. Are we in a recession? Are we in a booming time? And so on. So the important point to remember is this is the most volatile component. Because like I said, this is kind of stable. Interest rates are relatively stable. And then you know how much money you have on deposit. And you know how much you have on loan. So it's pretty easy to estimate these guys. But this is the wild card. And that's what could cause you to go bankrupt really quickly, among other things, which we'll talk about in the course. So now let's move on and look at types of commercial banks. But what exactly is a commercial bank? Well, a commercial bank is basically what I just showed you on the balance sheet. It's an institution that accepts deposits and then lends them out to individuals and businesses. And that's basically what a commercial bank is. Now, it has not only individuals, which are retail customers, but it also has firms and businesses as customers, and it sometimes can have government organizations and municipalities as customers also. So it can have retail customers, institutional customers, and even government and municipalities as customers. So now, what are the types of commercial banks? And here's where things get a little fuzzy. Okay, well, commercial banks are by far the most popular type of depository institution, and you're most likely familiar with them because you see branches all over the country that are commercial banks. They can be broken up into various types that are not clearly defined. They're a bit fuzzy, but I think you can follow it here. So the first type of bank is a community bank, and a community bank tends to be a smaller bank. In today's world, under $1 billion, it's not a hard definition in assets, under $1 billion in assets. And so community banks tend to service retail customers and small to mid-sized firms. And they're usually very small regional presence, what we call sometimes a small regional footprint. Then there's regional banks, which have a larger footprint that they cover. They cover a larger area, and they can cover institutions that are bigger in size, like mid-sized businesses. And then there's merchant banks now, which is not a very clear-cut definition of what a merchant bank is, but a merchant bank is usually a bank that doesn't deal with retail customers. And so they tend to deal with institutions and even governments and municipalities. You don't hear the term often as much, but that's how banks originally started, to facilitate business. Now, then there's also money center banks, which are the gigantic banks. They have international presence, and they can be merchant banks. For example, J.P. Morgan, a good part of J.P. Morgan Bank is merchant banking. It may have a small amount of retail customers, but not very much. And then there's Citigroup is another example of a money center bank. These are gigantic financial institutions that span the country and have offices around the world. If you're a community bank and you have customers that need foreign exchange transactions and things settled with foreign currency, that community bank is probably not going to go to a regional bank. It's probably going to go to a money center bank to help it execute the transactions. When a smaller bank goes and taps on the door of a money center bank to help out in more sophisticated transactions like international transactions, it's called correspondent banking. Sometimes banks will do banking for other banks. And also keep in mind, banks will do trust operations for other banks. And so trust operations, sometimes called wealth management today, where you're managing trusts and wealthy individuals' money. And it's financial advisory services and managing the money and holding the securities, possibly holding the securities. It doesn't require holding the securities. Holding securities is what custodial service is about. So if there's a mutual fund, another financial institution, or it even could be a community bank, it may want to hold securities, but it's not big enough and doesn't have the facilities, then it'll rely on a money center bank or a larger bank to do custodial services. And what exactly is that? Well, they're holding the securities in electronic form nowadays, but they're also taking in the dividends that come off those securities. They're collecting interest income that comes off those securities, and they're settling the securities. And settling securities means that the security moves and the money moves at the same time. So when you buy a security, like a bond, there's a transaction date that you agreed to do this, and then there's a few days later, depending on the type of bond or the security, the actual money changes hands and the securities itself changes hands. Well, the custodial services will handle that part of the business as good internal control, because you'd never want to say a mutual fund or another financial organization like a pension fund holding their own securities. You want to have an independent party collecting that cash, keeping track of those securities, and then giving monthly statements. Nowadays, periodic statements up to date constantly to the various institutions. So with this in mind, let's move forward here and look at commercial bank services a little bit more. So as you saw, banks can have loans, obviously. Now, what type of loans? Well, commercial and industrial loans, which are basically loans to businesses. It could be consumer loans, which are retail to individuals. There could be real estate loans. And real estate loans means it could be just the collateral that causes it to be real estate. It could be literally that they're lending money to buy real estate, but it could be that they're performing transactions where a substantial amount of real estate has been put up as collateral. And then there are mortgage loans, which you'd be familiar with, and then there's lease financing, which takes advantage of tax rate differences between businesses and banks. Sometimes it makes more sense for a bank to buy an asset and then lease it to another company rather than have the other company buy it outright. And that takes advantage of tax rate differences between the bank and the customer. We're not going to get into the details of that, but lease financing happens a lot. Now, let's look at just a thought process here about how banks price their loans. And when I say price means how do they set the interest rate on their loans? And it's often called base rate pricing. And that means the loan rate equals some base rate. And what do I mean by base rate? Well, it could be what's called the prime rate, the Fed funds rate, or the secured overnight funding rate. each one of these rates you'll hear about more, not so much the prime rate. The prime rate basically says, look, here's our prime customers and this is what we're charging them. So the Fed funds rate is the interest rate on overnight lending between banks. So banks need to meet reserve requirements, and on any given period, any given day, a bank may have excess reserves and another one might be deficient of reserves. And the Federal Reserve requires banks to compute their reserve requirements periodically. And if they're short, and you're going to borrow it from a bank that has excess reserves, in which case there's a market for reserves, and that's called the Fed funds market. We'll have a lot more to say about that. And so there's an interest rate associated with the Fed funds market called the Fed funds rate. There's also a newer rate called the secured overnight funding rate, which is a median, not an average, a median of rates that market participants pay to borrow cash on an overnight basis using Treasury as collateral. Okay, so it's a relatively low risk loan. That's why it's a base rate that's secured. It's overnight, it's not long term, and it's based on Treasuries as collateral, so it's nearly a risk-free interest rate. And so that's why it's a base rate. So you can think of that base rate as almost, conceptually, you could kind of think of it as a risk-free rate. And then on top of that, there's a default risk premium. You know, what's the chances of the customer defaulting? And so you're going to add a couple percent possibly onto the rate. And then there's a maturity risk premium, which is a function of how long the loan is going to be extended for. Is it going to be extended for 3 months, 6 months, a year, or more? And usually a year or more are called term loans. And then there's going to be a premium or possibly a discount, I should say plus or minus here, for local market conditions. So there should be a plus or minus here for local market conditions. You know, that's basically how base rate pricing works conceptually. Students often wonder, why would a bank want to borrow money just overnight? That's a really good question. If you work in a bank, and I experienced this myself, a bank has money coming in, just pouring in, and sometimes at some dates and sometimes during the day, and money is pouring out. You got people tapping ATMs, they're pulling down loans, they're tapping into revolving lines of credit unexpectedly. There's securities maturing. There is a lot of activity going on at any point in time in a bank in terms of its cash flow. It's really hard to keep track of it. I tried to one time, and it was very, very difficult. The point is that the changes in the money balances that a bank has is somewhat random. And so as soon as they run deficient, they borrow money immediately. And as soon as they have excess, they'll lend it immediately. So they may be in the market to borrow and lend throughout the day. And it's not just they figure out at the end of the day and settle things up and borrow one amount. They'll be in the markets throughout the day to be able to manage their cash balances. And by the way, the same thing happens with security dealers. Security dealers buy securities low and sell them high, kind of like a car dealer. But it's a little more complicated than that because security dealers, they post their prices on the internet, and they can't predict when people are going to buy and sell their securities. So they really can't keep track of how much cash flow they have at any given point in time. So when they run short on cash, they immediately borrow it. And when they have excess cash, they immediately lend it. And so that goes on throughout the day and not just settles once a day. They just don't figure it out once a week. They do it periodically throughout the day. Now, on the deposit side, we just saw that there are demand deposits, and that's an important term because that means you can literally pull your money out on demand. It's a first come, first served basis. So you can pull your money out on demand, all of it, at any time for any amount. And that's why they're called demand deposits. Now, banks have savings deposits, and they also have what's called time deposits, which are called CDs or certificates of deposit. There can be, in some cases, penalties for withdrawing money early. That money tends to be a bit more stable. The interest rates are a bit higher, but if you read the fine print on those deposits, they are not demand deposits. You can't withdraw your money on demand for those accounts. In a lot of cases, for example, with a savings account, you go to a bank and you want your money back on demand, on savings account immediately, they'll give it to you. But they don't have to. They can delay payment on savings accounts. And in retail and wholesale CDs, not only can they delay payment, but there's also a penalty associated with withdrawing the money early. So by the way, those types of accounts have lower reserve requirements since the bank doesn't have to legally pay you off immediately. They have lower reserve requirements. But a good estimate of reserve requirements for demand deposits before the coronavirus hit was 10%. Like I said earlier, it's been dropped to 0% now that the coronavirus hit. That should be temporary, but I can't really tell you what the definition of temporary is. Okay, so now let's clean this up and let's take a look at bank profitability. The first thing we want to look at is return on assets, which is equal to, at least the simplest way to calculate, is net income divided by total assets. And I say it's the simplest way. Technically, by the way, when you have a balance sheet and you have assets, you have liabilities, and you have equity, return on assets judges how well, in this case, how well a bank works its assets. How profitable are the bank's assets? Technically, net income, it's net income before interest expense, but we'll ignore that minor detail, and we'll just look at return on assets as net income divided by total assets. For our purposes, that's pretty good. Now, we also want to look at return on equity and how that gets spiked up with leverage. And it's an important concept in the world of banking, because what happens is banks love to be able to generate a ton of assets and hold lots of assets with as little capital as possible. And so that, the capital ratio requirement kind of prevents that from happening. If you didn't have a capital ratio, banks would have pretty small amounts of equity relative to their assets, which means they're leveraged up. So their equity is leveraged up, ownership is leveraged up. So the return on assets equals the return on equity equals the return on assets times a leverage factor. And so let's see if that works out. This is net income divided by total assets. And a leverage factor, one way to calculate it is how much assets do you have in total relative to equity. And we know the total assets cancel out. We get net income divided by equity, which is the return on equity. How are the shareholders doing, basically, is what the return on equity is going to tell you for a bank. And banks need to be really careful to make sure their leverage ratio doesn't go too high. That leverage ratio will vary over the business cycle. It'll be pro-cyclical, meaning when the economy gets strong and strong and strong and GDP goes up, it tends to be that leverage factor goes up. And so some people think, well, it's that leverage factor that's help drive gross domestic product going up, the amount of output that businesses generate. And that could be true, but nevertheless, for our purposes at this point in time, this leverage factor is going to be pro-cyclical. And when the economy starts to turn down, then banks are going to get nervous. Then they're going to try to reduce their total assets relative to equity. So when the economy turns down, banks start to lose money. They start to lose money. Their equity shrinks down pretty quickly. And so what banks want to do is they want to reduce their total assets. And so they start selling off and liquidating assets if they can. Now, if a lot of banks do that, that's the problem we have with liquidity in a recession. Too many financial institutions are trying to shrink their balance sheet by selling assets, and they're trying to get a hold of liquid assets like cash or reserves, which are hard to come by. Now let's look at a quick example of how leverage can hurt you or help you. So let's draw a new bank statement. So here we got the balance sheet. Let's say a bank has $100 in assets. It has $85 in deposits and liabilities and $15 in equity or capital. Well, what this means is, look, the leverage ratio, in this case, total assets to equity, is 85 divided by 15. That's 5.67 times. I should put it not percent, times. 5.67 times. And so what happens is assets have to drop off 15% before this capital drops down to zero. I would consider this to be a very capitalized bank in today's world. Now, what happens if instead we had a bank that had $5 in capital and $95 in deposits and money they've borrowed? So therefore, 95 divided by 5, that would be a 19 factor. Leverage would be substantially higher, and all that has to happen is this asset side only has to drop 5% before all this equity is gone. So now you can see that banks that have small amounts of equity, it's good because it spikes up that return on equity, right? But it means the bank is substantially leveraged. And as we'll see later on, banks are highly connected and they're subject to this business cycle, very important business cycle component that can cause them to lose a lot of money in an economic downturn. And equity can get wiped out pretty quickly. And it puts the FDIC deposit insurance fund in jeopardy. So now let's talk about savings institutions, which are slightly different than commercial banks, but years ago they were substantially more different than they are today. So what I'm saying is, look, the existence of savings institutions came about because of various niches that they filled years ago, especially in the area of mortgage lending. So commercial banks may have been busy with funding manufacturing and funding various institutions, but they often didn't have money for mortgages. And so savings and loans institutions came about. They specialized in lending mortgage money, but they also catered to specific types of customers. And that's what we want to talk about here. What are those other types of customers? Well, those other customers could be associated with a particular very large business, a very close-knit community. It could even be, for example, when we get down to credit unions at the bottom of this list, it could be a university credit union which services, for the most part, students and faculty and administrators of a university. So these institutions came about years ago, and they ended up specializing in various areas, like I said, mortgages. But over the years, regulations changed. Lots of deregulation happened, which was very abrupt, lots of deregulation. And then over the years, the compounding of also abrupt increases in regulation. It's now to the point where it's very, very difficult to discern, to figure out what really is the difference between a savings institution and a commercial bank. But there are some, and it's that focus and it's that history. And so they do act a bit differently. They look at their financial statements look a bit differently, but they basically perform a lot of the same services that a commercial bank does. So let's go down the list here. Savings and loans specifically started out by taking deposits, short-term deposits, and then lending them out in the form of mortgages. And we'll have something to say about that towards the end of this video. But there's a general mismatch in the maturities of those two. So notice what happens before we even get there. Look at the issues associated with a savings and loan. And you can see why there was a savings and loan crisis in the 1980s. Savings and loans take short-term deposits and they turn it into mortgages and they lend the money out that way. Well, mortgages can go 30 years, 25, 20 years, 10 years. What if people come to the bank, knock on the door, and they want to pull their money out? Well, they pull their money out. How's a bank going to fund those withdrawals? The money's tied up in mortgages that have maturities decades long. True. Yeah, you can see the problem there, that liquidity squeeze, which we'll talk about in what's called duration analysis and interest rate gap analysis. That's very important. In the 1980s, interest rates increased dramatically. There were restrictions on the amount of interest rate savings and loans could pay. So what people decided to do is just withdraw their money because they could put it elsewhere. They put it into the shadow banking system, which we'll talk about later. And then what happened was They ran out of liquidity. They started losing money. They started losing money because for the people that did keep their money in the bank, those interest rates skyrocketed. Those interest rates went up above the interest rates that they had on their mortgages. So while there may have been caps on the interest rates on those deposits, those caps were still higher than the interest rates that they were earning on the mortgage. And so what it really means is, look, there's what we call an interest rate gap. The deposits cost more than what these savings and loans were earning in terms of interest income on the mortgages. And that caused a savings and loan crisis. And it took a lot of deregulation to get that to work, so that both sides of the balance sheet were in sync with each other in terms of interest rates and maturities. We'll talk about that later. There's also savings banks, by the way, which also fund mortgages using deposits. There's not that money out there. Only certain states have them. And by the way, as you probably know, there's not that many savings and loans to begin with. There's even less savings banks out there. And then there's also credit unions. And like I said before, credit unions rally around a specific type of customer. For example, like a university or a certain region or a certain business. Now, a lot of these savings and loans and savings banks and credit unions have what's called a mutual ownership element. So when you deposit your money in those institutions, you become a part owner of those institutions. Not all of them. Some savings and loans, for example, issue common stock, and the stock is sold on exchanges. And so it's owned by public through stockholdership. But some of these have what's called, like I said, called a mutual ownership element to them, whereas the depositors own the financial institution. And then any extra income that's earned from the bank, any income the bank earns, the savings bank earns or the credit union earns, ends up going back to the depositors. Now what I want to do is I want to cover two types of short-term transactions that are out there in the financial world. These are institutional level transactions. You can't enter into these transactions as a retail investor. And so what I want to do is first cover repos, short for repurchase agreements. Then what I'll do is I'll cover asset-backed commercial paper and just plain commercial paper. Repos are things that can be on both sides of the balance sheet for a bank. And here's how they work. It's short-term funding. There's two legs. There's leg one that happens on day one, and then day two, the transaction unwinds. So I'm talking about overnight repos, repurchase agreements. They can happen one night, a couple of days. They can go as long as a week and possibly longer. And when they're longer than a day, they're usually called term repos. Let's just talk about an overnight repo. And so on day one, there's a transaction. And then when you enter into this transaction on day one, there's an agreement to unwind the transaction on day two. So what happens? Well, let's talk about it in terms of a bank or a securities dealer needing funding. And so here you have an institution that needs money. And you have another institution with excess money. So a bank or a securities dealer with excess money, they don't want to hold it because there's opportunity costs associated with it. And there's organizations like banks and securities dealers that need money on a continuous basis because they buy securities. At any given point, they don't know if they're going to buy securities or not. And so remember what happens here. Remember from the dealer perspective. So from a dealer's perspective, a dealer posts bid prices and ask prices. So this is their bid and this is their ask. Any one time they're willing to buy a security at 100 and they're willing to sell it at 101. That difference is their spread or their profit. Now, since they post this bid, anybody could come along and say, look, I want to sell to you at 100. And the dealer is going to have to follow along with the transaction because the dealer posts this bid price. This is what they're willing to buy it at. So somebody comes along and is offering to sell at 100. This dealer needs to get the cash to buy at 100. And on the other side here, if somebody wants to buy from the dealer, then the dealer is going to get $101 in cash. And what are they going to do with that cash? They just don't want to sit on it. They want to earn some income off it. And so hence this situation will motivate the need for a repurchase agreement. And the same thing goes on with a bank. Like I said earlier, a bank has cash coming in at all different times during the day. It can't necessarily predict it. It will try to predict it, but there's a lot of random elements to it. And then there's a lot of random elements to when cash gets drawn out of a bank. And so banks are going to be in the same situation as a securities dealer. Hence these things called repos, which are overnight lending to make sure that financial institutions have the cash they need, and that the banks and other financial institutions that have excess cash, they earn some money on it. So here's what happens in day one. In day one, this party needs money, and so the money is going to move from the lender to the borrower, and at the same time, it's going to be a collateralized loan, and collateral like a treasury security will go in this direction. Now, you can look at this as I'm basically telling you, this is a borrowing that's going on with collateral, but it also looks a lot like a sale. It looks like this party is buying a security. So here's the security coming in through collateral, and they're paying this money. This party's selling the security. Hence, when you look at repurchase agreements, it's as though there's both a borrowing and a lending going on. Now, day two, the second leg, is this transaction unwinds. And so what happens is money goes in this direction along with interest. The original money that was sent over goes back to this party plus interest. So this person earns interest income, this one earns interest expense or pays interest expense. And then the collateral moves in this direction. So it unwinds. Or basically, this party repurchases the security that they sold to this party in this leg. That's a repurchase agreement. It happens all the time. It's the banks are involved in repurchase agreements. Pension funds are involved in repurchase agreements. When I audited mutual funds, it used to be like they would just do $100 million repurchase agreement with a snap of the fingers because they either had excess cash or they needed cash. And so it's very popular. Even the Federal Reserve does repos. It does a lot of repurchase agreements with individual banks. Now what I want to do is cover commercial paper, the concept of commercial paper, and then asset-backed commercial paper. Oh, and by the way, let me bring this back here. Let's look at this from the balance sheet perspective here. Let's say this is A, this is party B. This could be a bank, this could be a securities dealer. So here we got the balance sheet of the bank. What happens here? Well, cash goes up. Let's say it's $10. Let's say the transaction's for $10. Then short-term debt goes up 10. So our balance sheet balances. The bank gets its cash. It has an obligation related to the repo. Now what about B? Well, B, if B is a security dealer, their cash went down by 10, and then they have a receivable for a repo of 10, so their balance sheet balances. Then when the second leg comes around, this disappears, this disappears, this disappears, this disappears. The balance sheets pretty much look like they did before we started the repo, except that there will be a little bit more cash on B's books because B earned some interest income, and then A will have a little less cash because they paid interest expense, and the income statements will reflect that also. At this point, let me add a technical note. Often when repos are discussed in the media, financial press, Wall Street Journal, CNBC, for example, they just refer to repos as repos. It doesn't matter what side, what party is taking what side, whether it's a receivable or it's a payable, they just generically call it repos. But when you get into the financial world, and you dig deeper into the financial world, they'll specifically label the receivable that's on the asset side as a reverse repo. And they'll label the party that has the payable as a repo. It's just a technical term so that you know which party is doing what in a repo. It's just financial institution jargon. Okay, now let's talk about commercial paper, abbreviated CP. So let me give you a little background on commercial paper. Commercial paper is issued by corporations, usually very well-known companies, household names. And it's issued short-term, it's basically short-term debt. And it's short-term under 270 days because that's what the regulations require it to be, under 270 day maturity. And so here's the logic behind why commercial paper is so popular in our economy. Let's say you wanted to issue short-term debt and you were a business and there wasn't any commercial paper regulations around. Nobody knew what commercial paper was. So you had to issue short-term debt and you wanted to issue it in the debt markets, meaning going to the bond market rather than going through a bank. Then what you'd have to do is you'd have to file a registration and you'd have to get a bunch of accountants and you get the lawyers there and you get the investment bankers to help price the debt issuance, figure out what the coupon rate is, what type of security it'll be. It would take you forever to do that. And by the time you did it, you'd probably go bankrupt because you went insolvent because you just didn't have the cash when you needed it. So there's a mechanism in our society, in our business world, to take care of problems like that. And it's called the commercial paper market. And it's not made for individuals. It's for the big players, for the institutions. And it works like this. Basically, the company will get an agreement from the Securities and Exchange Commission that allows them to issue commercial paper up to 270 days. And they can issue it basically on the fly, on the dime, so to speak. So we're talking unsecured at this point. And so when the need arises for a company to borrow money, it simply issues the commercial paper, sells it very quickly in the market, and then collects the cash. And then eventually, in a couple months later, it could be 3 months, all the way up to 270 days, which is 9 months, it could mature and they pay that commercial paper off and they reissue more paper. And they keep rolling it over. And so that's the way the commercial paper market works. It's a very fast-paced market and very convenient. So what happened over the years was that, not all companies are big household names. And so a lot of smaller companies started to get into the racket of commercial paper. I shouldn't call it a racket, but into the business of commercial paper. But the problem is, they're not household names. And so who's going to buy unsecured debt from a firm you never heard of? Well, there's one way you can correct that and try to take that into consideration, and that's by attaching collateral. It's a bit more involved, but it'll actually work. It'll work in today's world because we have computers to help process the collateral. And so the collateral here now is not like a manufacturing company. It's not like a piece of land. The collateral are, for example, mortgages or accounts receivable or some other relatively liquid financial asset that can be used as collateral for short-term debt. And then when that happens, it's called asset-backed commercial paper. So the real true commercial paper market, the CP market, is unsecured short-term debt. And then when you start attaching collateral like mortgages or some loan receivables or accounts receivable, then it becomes asset-backed commercial paper. Because it's asset-backed, it just means there's collateral behind it. Now we could leave the story at that, but I want to go further because we're in a chapter in a video on balance sheets. Let's look at what happens when what's called a mortgage bundler uses commercial paper. And before we talk about how a mortgage bundler uses commercial paper, what is a mortgage bundler? Well, here's the situation. So here's a mortgage bundler's balance sheet. Okay, what mortgage bundlers do is they buy residential mortgages. Okay, so it shows up on their balance sheet as residential. You can't read that. Just call it RM, residential mortgages. And the question is, well, where do they actually finance these residential mortgages that they buy? Well, they're going to issue commercial paper. If this is a well-known company that everybody's heard of, then it will be easy for this company to issue this commercial paper without any collateral. So it issues this debt, it gets the cash that was used to fund this residential mortgage, this package of residential mortgages. Now, what does a mortgage bundler do? Well, what it does is it buys these residential mortgages and it transforms the mortgages into residential mortgage-backed securities. So it may buy thousands of mortgages from a bank. And so here's a bank. The bank had money locked up in mortgages. And when it has money locked up on mortgages on its balance sheet, it's not very liquid. So it would be nice if the bank could get these mortgages off its balance sheet and turn that into fresh cash. So the bank sells the mortgages to the mortgage bundler. The bank gets cash, and the mortgage bundler gets the cash by issuing commercial paper. So the commercial paper is used to buy the residential mortgages to pay off the bank. Okay, so now the mortgages have moved off the balance sheet of the bank, and there they are on the bundler's balance sheet. They don't sit there very long. It takes a couple of months for the bundler to buy thousands of mortgages, process them, and turn them into residential mortgage-backed securities, bonds that are sold in the bond market. And so what happens is these disappear, and now they have mortgage-backed securities, residential mortgage-backed securities. The balance sheet still balances because whatever they borrowed here, let's assume it's the same amount in terms of residential mortgages that were purchased. I taught an entire course on bonds one time, and I spent 2 chapters on just this process. There's a lot involved. The point is, we don't want to get into all those details. We just want to see how it affects balance sheets and how it affects a bank. But that's what happens with banks. Banks get overloaded with mortgages and they run out of cash, basically. One way to get fresh cash on their books is to sell it to a mortgage bundler, who turns around and sells these in the bond market. Eventually, the mortgage bundler sells these in the bond market, and these go and they disappear, and they get the cash for it. And when they get the cash, they pay off the commercial paper. And there it is. It's done and gone. And they go back and they buy more residential mortgages from other institutions. Later on, we'll ask the question, well, who buys this commercial paper? And that's where money market mutual funds come into play. Another video for another time. So now, one other thing, how does this relate to asset-backed commercial paper? Well, if this mortgage bundler was a company that nobody ever heard of, then when they issued this commercial paper, in order to have those money market mutual funds buy this commercial paper, they're going to want some collateral, something to secure it. Well, what they're going to do is they're going to issue asset-backed commercial paper, and what's it going to be backed by? It's going to be backed by these mortgages, and then eventually backed by these residential mortgages until it's sold. And then when those mortgage-backed securities are sold, it'll pay off that asset-backed collateral. That's where the word and the concept of asset-backed commercial paper comes into play. And by the way, this is a form of a shadow bank. A mortgage bundler is like a shadow bank, is an example of a shadow bank. Okay, so now what we want to do, now we just covered repos, we just looked at commercial paper. Let's talk about duration analysis and interest rate risk. Let's start off our analysis with a bank balance sheet. We're going to assume that the bank has sensitive assets of 300. And what do I mean by sensitive? I'll just label them S. Interest rate sensitive. And then we're going to have non-interest rate sensitive assets of 700. So therefore, total assets will be 1,000. Then we're going to look at the liability side, and we're going to have 200 in non-sensitive. Well, I should put it here. 200 in non-sensitive. And 700, that's a 700 in sensitive, interest rate sensitive assets. Now, what do I mean by sensitive and non-sensitive assets in terms of interest rates? Well, S can be, sensitive assets can be variable rate long-term loans or short-term assets or liabilities that reprice In other words, they reprice periodically, quickly. In other words, they roll over and a new interest rate is determined. An example of a long-term variable rate loan would be a mortgage where the interest rate changes along with market interest rates. And the point is it's interest rate sensitive because the interest income coming off of that mortgage varies with interest rates. So when the interest rates in the market change, the interest income that mortgage generates changes. That's what we mean by interest sensitive. Then short-term securities, short-term assets like treasury bills, for example, they mature very quickly. And so when interest rates change, you end up rolling over into a higher earning security, for example. If interest rates go up, if interest rates go down, you end up rolling over into a lower interest rate security. And so interest income varies with changes in interest rates in the general market. So now, let's see, 1,000. So now what we want to do is we want to analyze this situation. Let's assume that the interest rate on assets, the asset interest rate, I, is 5%, and the liability, I, interest rate is 3%. When we look at this, we have, in this particular situation, we'll have interest income equal to $1,000 times 0.05, that equals 50. We'll have interest expense equal to 900. That's 900 in total right here. 900 times 0.03, it's 27. So we have, remember that spread, interest rate spread or net interest margin of 23 to start off with at this point. Now what we want to do is we want to see what happens when interest rates rise by 200 basis points. This interest rate goes to 7% for assets, and this interest rate goes to 5% for liabilities. But it only changes for the sensitive assets and the sensitive liabilities. So let's do the calculation for this calculation now on net interest income and expense. So interest income will be 300 times 0.07 equals 21. So see, this goes up from 5% to 7%. And then the insensitive stays the same at 5. So you can see it's insensitive to interest rates. This is 35. So interest income is a total of 56. And then interest expense is made up of 200 times 0.03, the non-sensitive, the insensitive stuff here. That's 6. And then 700 times 0.05, because that's sensitive. So it went up 200 basis points. And this is 35, and that's 41. The difference here is 15. There's about a 1/3 drop in spread. So spread went from 23 to 15 in this situation when interest rates rose. Now what we want to do is like, well, why did this happen? Let's try to diagnose what happened. Well, just look at the balance sheet here in the asset side. You had assets where most of them were non-sensitive, and they only had a few that were sensitive to the rise in interest rates. And so those sensitive assets, which basically we would refer to them as repricing, they repriced from 5% up to 7%. So you can think of these as short-term assets. The way you can think about this is, look, interest rates rose, but it takes time for the change in interest rates to start having an effect, because it's not just the interest rate, it's interest rates relative to time. And what I'm assuming here is we're looking at a year, because I'm just taking the interest rates and I'm not adjusting, and I'm not dividing by 2 for 6 months. I'm not dividing by 4 for a quarterly. And all interest rates almost always in the world of finance And that includes not just academic finance, but in the real world, almost all interest rates are disclosed on an annual basis. So I'm looking at this as spread for a year, and this is spread for a year when I multiply it by these interest rates. And what happened here is, look, these assets repriced and got the higher interest rate, but these didn't. These are kind of like mortgages. They're kind of like fixed rate mortgages. That's right. Fixed rate mortgages, they could have been issued and put on the books here 20 years ago. They're not going to budge when interest rates budge. Here there could be short-term treasury securities which roll over and into a higher interest rate, or it could be variable rate securities where when interest rates go up, the interest rate for this particular security will go up also. Now let's look over here. This, by the way, this is an S here. When interest rates went up, this bank had to pay the higher interest rate. It's kind of like having short-term CDs, certificates of deposit, maybe 3-month CDs. So as soon as interest rates go up, these things will start to mature relatively quickly. And because of that, you're going to have to, as a bank, they're going to have to pay higher interest rates. Now, these could be very long-term CDs or long-term debt. Well, we don't really care much because with that interest rates went up, because look, interest rates go up, they're not affected. So what you have here is a mismatch between sensitive and non-sensitive on both sides. That causes a problem in the banking world. This is reminiscent of what happened to the savings and loan crisis in the 1980s. I mean, it ended in the 1980s, but it took about 15 years going down the tubes. It took them a long time, but finally it broke in the 1980s, where most of their capital was depleted. So the point is that if this happens, if you have a bank set up like this, it's subject to interest rate risk on the negative side when interest rates go up. Now, you could easily swap these sensitive and non-sensitive and then look at what happens when interest rates go down. And so when interest rates go down, what would end up happening is the interest rate that you earn on assets would drop, while the interest rates that you're basically on average paying on this side would stay fixed, and then you're caught in a squeeze from a different angle, interest rates falling. So my point is here that you should have a relative balance between your sensitive and non-sensitive assets and liabilities. And this is not balanced, obviously. So this is part of interest rate management that banks are required to do. They need to keep track of how sensitive their assets and liabilities are to changes in interest rates. By the way, I forgot to put this in. There's equity of $100 here. So now, what is duration analysis about? Well, duration analysis looks at changes in market value due to changes in interest rates. So if you recall from the bond market, if you studied bonds, and when interest rates change, bond prices change, their prices change. So we didn't really reflect in any of this analysis changes in the value of assets or liabilities. We just looked at the effect on interest income and interest expense and calculated net margin. But what if the bank held treasury securities and loans, right? And interest rates went up. Well, if that interest rates go up, bond prices and loans are like a bond because they're interest rate sensitive. Interest rates go up, the value of those loans and securities will drop. So this will have a big drop here if you have very sensitive long-term securities, bonds, and long-term loans. And if what happens is this has a very low duration and they're not very sensitive to changes in interest rates, what that means is when there's an increase in interest rates, this will drop significantly, but this will barely move. So wait a second. This drops significantly, this barely moves. That means your equity is going to get eaten away pretty quickly. That's what duration analysis can do for you. We're not going to actually calculate duration analysis. If you take investment management, we cover it. We calculate it and we analyze it carefully. And it's quite involved. So it takes a good part of a lecture to describe how duration analysis works and its calculations. My point here is just to talk about duration analysis. So what I'm saying is that this type of analysis where we calculate net spread, net interest margin and spread here, this is incomplete. It's valuable, it's important, but we also need to look at changes in market values, because if market values change on both sides here, they're not going to change equally if you have some assets that are interest rate sensitive and some that are not. And if these sides change differently, your equity probably can get squeezed. Actually, your equity can go up or it can get squeezed significantly, and you have interest rate risk. So this is one way of calculating interest rate risk using spread, and the other way would be to use duration to look at changes in market value. The two methods complement each other nicely. Okay, now let's look at shadow banks a bit more closely, and let's carefully consider the definition of a shadow bank. There's a couple of definitions that float around in the literature on shadow banks. One would be a shadow bank is a financial institution that avoids regulation. And what I mean by that is, look, there's banks and there's other financial institutions that are heavily regulated. And then there are institutions that over the years have popped up to avoid that regulation as best they can. And that's what's meant by shadow banks. Now, what I'm talking about here when I'm referring to shadow banks is generally I'm talking about institutions that are basically stealing the business of regular commercial banks. So when I'm talking about shadow banks, usually in this course, what I'm talking about is financial institutions that have popped up that avoid regulations that banks have imposed on them by regulators like the FDIC and the Federal Reserve. And in the process, these shadow banks steal the business of regular commercial banks. And so what regulations am I talking about? Well, we've covered them in a sense. You got a bank, and we have reserves, which is cash. Call it $90. We said loans of 910, so the assets are 1,000. We gave the bank capital or equity of 100, and then we had 900 in demand deposits. What are the two main taxes that a bank has in terms of regulations? There's more, obviously, but let's focus on them. Is one, these reserve requirements of 10% are basically a tax on a bank, on a commercial bank. And if you can avoid those reserve requirements, then you're going to be more profitable as a financial institution. So if you have to hold cash of 90, and that cash here, these reserves, earn very, very low interest rates compared to loans, that's a tax. And the other tax is banks have to keep a certain amount of equity. And so when you have a certain amount of equity here, it means you're not leveraged up as much. So banks can't leverage themselves up as much as other financial institutions that are not regulated in terms of capital ratios. So let's look at three different types of shadow banks. So we've seen the bundler, the mortgage bundler. And by the way, it doesn't have to be just a mortgage bundler. It could be a credit card bundler. So you can do the same thing with credit card loans, and you can do the same thing with boat loans, and you can do the same thing with accounts receivable also. And so the bundler has, let's do it in terms of residential mortgages. Remember, buys residential mortgages, turns them into residential mortgage-backed securities, and issues commercial paper to do that. And then they also do repos to fund them. So you got this bundler, and it's borrowing short-term in the commercial paper market. It could be asset-backed or may not be asset-backed. And then they're using repos to fund the buying of these mortgages and the process of packaging them, then reselling these and then paying off the short-term debt. Now, stop right there and look what happens. Mortgages are long-term assets. In a lot of cases, they're fixed assets, fixed returns, fixed interest rates. And then you have this short-term debt. You have a huge mismatch here in terms of interest rate sensitivity and interest rate risk. This rolls over continuously, and this is long-term. So what these institutions do is they do two things to try to balance this out in terms of interest rate risk and sensitivity. One is they employ interest rate swaps. In interest rate swaps, it's not part of this course, but is part of financial engineering. And that basically allows them to reduce the interest rate risk associated with having short-term commercial paper and repos here and long-term assets here that are fixed. So the interest rate swaps will help get rid of that mismatch, and then they'll end up entering into credit default swaps, because this side here, mortgages have credit risk because people can fail to pay their mortgages if there's an economic downturn. In order to hedge that risk and get rid of that risk, they enter into credit default swaps. And basically, this is basically money market type risks here. And now with the interest rate swap and the credit default swap, this has money market type risks associated with it also. So this model was developed by, I think I'm spelling his name right, Merling. He's a Columbian professor, University of Columbia professor. He's tried to summarize what shadow banks do in a nutshell, if he can. Shadow banks are very complex. There's lots of different versions of them, but he basically tried to boil it down, at least in terms of a mortgage bundler. Now, that's one model. Oh, and by the way, one of the reasons this is a shadow bank, you might ask, well, why is this a shadow bank? Well, look, this mortgage bundler is in the business of dealing with these mortgages, just like banks are. So banks can originate mortgages, residential mortgages, and the banks can package them up and sell them as mortgage-backed securities. But so why is the bundler involved, and what's the advantage of the bundler? Well, the bundler is not taking deposits. This bundler doesn't have reserve requirements. This bundler doesn't have capital ratio requirements because it's basically not a bank. It's not taking deposits. So you can have an institution that deals with loans and even could originate loans, but if it's not taking deposits, then it's not a bank. It's not a commercial bank. Before I go one step further, make sure it's clear that those interest rate swaps and those credit default swaps are not on the balance sheet. They are off balance sheet items. The way I have it shown there, it kind of looks like it's on the asset side of the balance sheet. Not true. They're off balance sheet items for the most part. The accounting's a little tricky. We're not going to get into that, but interest rate swaps and credit default swaps are off balance sheet items. And basically you have a balance sheet, you add the off balance sheet items, and then you have a complete financial picture of the company. Now, let's look at money market mutual funds, because remember, we have to ask, well, if these guys are issuing commercial paper and repos, then who's buying them? Well, who's buying them are money market mutual funds. So money market mutual funds will buy commercial paper, they'll buy repos, which are interest earning assets from this side, okay? Because these people here, this company is paying interest expense. These guys, when they own them, are going to get interest income. And so how is it funded? Well, money market mutual funds sell shares. They don't issue deposits, so they're not subject to reserve requirements. And capital ratios don't really make sense, because when you sell shares and almost all of your balance sheet on this side is shares, then you don't have to worry about a capital ratio because nearly everything's equity. So there's another example of a shadow bank that avoids regulation, specifically regulation that strangles commercial banks. The story is actually more involved. These money market mutual funds came about in the early 1970s. And in the early 1970s, banks and savings and loans had interest rate caps on the amount of interest that they could pay on a deposit and their borrowings. And that requirement and regulation came about from the Great Depression, because at the time, regulators of banks did not want banks to compete really heavy by paying high interest rates, because if they paid really high interest rates, they could pay interest rates that were so high that it would drive them out of business and cause systemic risk to the banking system. So there was, for a long time, decades, interest rate ceilings according to regulations. And so money market mutual funds took advantage of that, and they offered these shares at $1 per share. So each share kind of acted and behaved like a savings account, because when you put your $1 into a savings account, it remained as $1, and then it accrued interest. Here, you buy $1 shares, and basically it earns this income, and this fund declares an itty-bitty little dividend every single day, and that dividend accumulates over time. So these shares were designed to mimic savings accounts, the banks, and demand deposits in banks, but yet earn a good interest rate. Now the next type of shadow bank would be a mortgage lender. So mortgage lender originates residential mortgages and borrows money. But notice, it's borrowing money in the debt market. It's not taking deposits. Okay, so it doesn't have reserve requirements. And if it's a mortgage lender, it's not going to have capital requirements like banks have. So again, these guys can avoid all the heavy regulation simply by not taking deposits and borrowing money instead. So those are 3 examples of shadow banks that have popped up in the past 50 years. These popped up in the 70s. These popped up mainly in the late 90s and 2000s. And these mortgage lenders have been around for a while. But the point is, over time, they've stole a lot of the business of commercial banks because commercial banking is heavily regulated. And when you're heavily regulated, those regulations translate into taxes, basically, for a bank. Now that we studied balance sheets for a commercial bank and savings and loans institutions, let's look to see what they actually look like. And what I mean by actually look like, what I have in front of you is the FDIC aggregate database. This aggregates all of the commercial banks and savings and loans institutions that are under the FDIC insurance umbrella, Federal Deposit Insurance Company. Let's take a look at what these numbers represent. I got the last quarter of 2019, the first quarter of 2020, and the second quarter of 2020 here. So first off, let's look at the number of institutions reporting. Right now, in the middle of 2020, I'll tend to look at the last column. It's about 5,000 institutions. That number has been coming down since the early 80s. The number went from about 14,000 institutions down to 5,000. Most of them have been consolidated. There's been a huge consolidation process that's going on in financial institutions. When I worked in a bank holding company, we would frequently buy up banks and merge them into our existing portfolio. So now we have fewer banks, but the banks tend to be larger. In fact, some of them are huge at this point. If you look at the size of the money center banks, some of those have assets that are in the trillions. Then the number of employees is about 2 million employees, full-time equivalents. Now let's look at the assets. Now the assets here are in millions of dollars, so these are really big numbers. We're looking at cash and due from depository institutions. In other words, that's correspondent banking, that due from depository institutions. That's about $3 trillion, or 14% of the total assets of these institutions. $2.8 trillion doesn't have much context for you or for me, and if we put it in as a percent of total assets, it scales it down to something that's more comprehensible. Actually, we can go a bit further with this analysis from a couple of different angles, and here's what I'm thinking. One is we're in an environment of ample reserves, which means there's no reserve requirements since Corona hit, which means that's a lot of cash sitting there, and it's not required to be there. I mean, banks obviously need liquidity, but it's far more than they actually need to conduct business. And the other angle you could look at this from is, look, the reserve requirements for a long time on transactional deposits, which are mainly demand deposits, have been 10%. And while this FDIC statement doesn't tell us what demand deposits are or what transactional deposits are, we know, looking at the Federal Reserve Economic Database, that they're about 18% of total assets. My point being that these reserves that we see, this cash balance, is far in excess of what's required. So most of it's excess reserves, which we'll talk a lot about as we go further into this course, because it has important economic implications. Now look, here's Fed funds. The next line is Fed funds sold. and repurchase agreements. These are receivables. So this is money that's been lent out. They're earning interest income on federal funds between banks and then reverse repos with other financial institutions. And that's just under $1 trillion. Now let's look at securities. Securities overall are about $4.5 trillion, 21% of total assets. And look down, you got available for sale. So they're accounted for at fair value, held to maturity, which is usually short-term securities that are accounted for at amortized cost. There's U.S. Treasury securities, as we mentioned. There's mortgage-backed securities that we had referred to in this video. There's municipal and state securities. And then they hold a little bit of equity, almost immaterial. Some common stock somewhere along the line. Sometimes we refer to the fact that they're not allowed to hold equity securities. Well, that's true and not true. The regulations make holding equities not very profitable and actually very costly, and banks simply just don't hold them. Now let's look at the loan portfolio. And so here you got loans secured by real estate. So I had mentioned that somewhere in the video that you can have loans, and the loans may be used for various reasons. But if they're secured by real estate, that might be the common denominator on how they're classified. So we look at 1 to 4 family residential mortgages. Well, that's obvious what they are. So that's 10% of assets overall. And we go down, we look at commercial and industrial loans, about 13%. We come down, we could calculate that. Right there. Yep, so loans and leases are a total of 52% of the assets of a bank. Come down, there's other real estate owned, that's foreclosed real estate. Usually that's how banks end up holding a portfolio of real estate. They lent money to various individuals and corporations that failed to pay back the loans. The bank foreclosed on the real estate. The values of those properties are sitting in other real estate until it's sold. And then there's some trading accounts. Banks trade usually in the bond market, in other assets, and maybe in the derivatives market. It's a small percent of the total assets. Then bank premises and fixed assets are very, very small. And then we come down. Let's look at the liability side. So you see deposits are 80% of liabilities. That's 80% of total liabilities plus equity. And we get down, we look at domestic office. Most of it's 73% in domestic offices. A good chunk of it's interest-bearing deposits. And even, 20% is non-interest-bearing. And then there's an estimated, the amount of deposits that are insured by the FDIC. Because remember, there's a cap on the insurance amount. That's $250,000 per depositor per insured bank, and for each account ownership category. And account ownership categories could be things like single account, joint account, retirement account, various trust types, and so on, that we'll talk about later in the course. And so estimated deposits, about 42% are covered by insurance. Then there's time deposits, which are CDs. There's brokered deposits. And so brokered deposits are interesting and can be quite risky, because normally banks pool money out of their local economy. People deposit money in the bank from their local economy, and they're basically retail CDs. But sometimes banks are in a pinch for funding, and they'll contact a CD broker that will scrape money up from all over the country at good rates, and the bank will take those deposits. Those are called brokered deposits. It's about 6%. They usually have a minimum balance of $1 million, so they're institutional and very flighty, meaning those brokered deposits can be withdrawn very, very quickly. And so that causes a problem on the other side of the balance sheet. It's like, how do you scrape up the cash to pay off those brokered deposits if they're very flighty? Then we see Fed funds purchased and repurchase agreements. So here they're calling them repurchase agreements because it's a payable. These are Fed funds that have been purchased that are owed. They basically borrowed these Fed funds, and they borrowed money through repurchase agreements. Now, if you look above and you go above and you look at the Fed funds and the repo number, they don't match up. So the Fed funds purchased and repurchased liability doesn't match up with the receivable up top. That's because banks are dealing with, in some cases, Fed funds and repurchase agreements with institutions that are outside of the banking system. So some of it's done within the banking system and some of it's done with outside of the banking system. If all these transactions were done within the banking system, then the receivable would equal the payable because it would net out. Come down, subordinated debt is kind of low. And let's see, we have equity. So equity, notice equity is about 10% of the portfolio, total equity, which is what we've been referring to. That's basically a capital requirement of ballpark 10% in the simplest way of calculating an equity ratio. Then down below we have Tier 1 risk-based capital. We'll talk about that later in another video, and that's about 8.5%. And then we have loans that are past due. This is information side notes that regulators would want to know. How many loans are past due, 30 to 89 days. And then assets that are in foreign offices. And then unused commitments in total. Those are off-balance sheet items. So they're not in the balance sheet. That stuff that's above, where it talks about loans and leases that are 30 to 90 days past due, those assets are on the bank's balance sheet. But down below where it talks about unused loan commitments, those are off-balance sheet items. So we have unused HECLs, home equity credit lines, unused credit card lines, and so on. Those are all potential funding obligations coming up. Those are all potential funding obligations that the bank may have to honor in the future. And so the FDIC wants to know how much is out there in terms of those obligations. So that concludes this video on depository institutions' balance sheets.